Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 144, and in this episode we are reviewing the performance of the global markets during the fourth week of 2025, and that is from Monday the 20th to Friday the 24th of January. And without further ado, this is your host, Jamhuri, and together, let's dive right in. And we kick it off by looking at the latest World Economic Outlook update that is dated January 2025 and published by the International Monetary Fund. According to this report, global growth is projected at 3.3% in 2025, which is below the historical average of 3.7%. The forecast for 2025 is broadly unchanged from the previous report dated October 2024, primarily on account of an upward revision in the United States, which has offset a downward revision in other major economies. Meanwhile, global headline inflation is expected to decline to 4.2% in 2025 and is also projected to converge back to the target range at a much faster pace in advanced economies than it will in emerging markets and developing economies. On Wall Street this past week, the S&P 500 closed lower after hitting new record highs on Friday as investors took some profit to end a solid week centered on President Donald Trump's return to the White House. Some mega-cap tech stocks that helped drive the market to all-time highs pulled back during the session, putting downward pressure on equities. Case in point, Nvidia slid more than 3%, while Tesla fell more than 1%. Despite Friday's retreat, excitement towards Trump's pro-business policies has largely pushed risk assets higher this week as investors focused on his inauguration. Friday's losses snapped a 4-day winning streak for all the three major indices. But despite Friday's dip, the benchmark S&P 500 recorded a weekly gain of around 1.7% to close at 6,101. Meanwhile, the Nasdaq Composite also rose by 1.7% to end the week at 19,954, and the Dow Jones Industrial Average increased by 2.2% to eventually settle at 44,424. In the U.S. Treasury bond market, The yields on U.S. Treasuries wavered on Friday as investors reacted to President Trump's latest comments as he addressed global leaders at the World Economic Forum in Davos, Switzerland. The newly inaugurated president took a swipe at the Federal Reserve regarding interest rates as he demanded that interest rates drop immediately. These comments come ahead of the Federal Reserve's next policy meeting that is scheduled for the 28th and 29th of January, where markets are pricing in an almost 100% chance that the Federal Reserve will hold interest rates steady at the current levels of between 4.25% to 4.5%. On the contrary, BlackRock CEO Larry Fink told CNBC's Squawk Box that Trump's plans to inject huge amounts of capital into the private sector may create new inflationary pressures. All said and done, the yield on the benchmark 10-year Treasury bond fell about 2 basis points to level off at 4.62%, whilst the yield on the policy-sensitive 2-year Treasury note slipped just under 2 basis points to settle at 4.26%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the foreign exchange market, the dollar fell on Friday and was on track for its worst weekly performance in more than 1 year on a change in expectations that the tariffs proposed by President Trump will be lower than previously stated and will therefore be unlikely to spur an international trade war. The prospect of higher tariffs on goods imported from certain countries, including China, Canada, Mexico, and the European Union, had raised concerns about a renewed bout of inflation, which in turn helped to prop up U.S. Treasuries and has given the dollar a yield advantage over other major currencies. However, that move was partially reversed this week as traders bet that tariffs may not be as large as previously expected, as President Trump held a conversation with Chinese President Xi Jinping and thereafter said he thought that the U.S. could reach a trade deal with China. In response, the US dollar index was on track for a weekly loss of about 1.8% and was down from a peak of 110.17 that was hit on the 13th of January before eventually coming to a close at a reading of 107.43. In the commodity markets, the price of crude oil was steady on Friday, but still posted a weekly decline, bringing to an end 4 straight weeks of gains, and this came after the newly inaugurated U.S. president announced sweeping plans to boost domestic production and at the same time demanded that OPEC move to lower crude oil prices. On Thursday, Trump told the World Economic Forum that he would demand that OPEC and its de facto leader, Saudi Arabia, bring down crude oil prices. The following day, on Friday, Trump reiterated his call for the Organization of Petroleum Exporting Countries to cut oil prices with a view to denting Russia's finances and helping to bring an end to the war in Ukraine. On the other hand, the threat of additional U.S. sanctions on Russian and Iranian crude oil exports could undermine Trump's goal of lowering the cost of energy. For the week, the price of the global benchmark Brent crude lost about 2.8% to close at $78.50 a barrel. Meanwhile, the U.S. benchmark, West Texas Intermediate crude, was down by about 4.1% for the week to settle at $74.66 per barrel. In the precious metals market, the price of gold rose just over 1% on Friday and was closing in on its all-time high, driven mainly by a weakening US dollar following President Trump's push for lower interest rates that drove the precious yellow metal towards its fourth consecutive weekly increase. At the World Economic Forum on Thursday, newly inaugurated US President Trump called for an immediate reduction in interest rates, causing the dollar to hit over a one-month low and in the process making bullion less expensive for foreign buyers. On the flip side, Trump's proposed tariffs run the risk of elevating prices and driving up inflationary pressures and causing the Federal Reserve to adopt a tighter monetary policy stance that could see interest rates remain higher for much longer than previously anticipated. In the current climate of uncertainty, non-yielding gold is expected to remain as a reliable hedge against inflation and instability, whilst retaining investor appeal in a low interest rate environment. At the end of the week, the price of spot gold was up by 2.9%, but was just a tad bit lower than its all-time record high of $2,790 as it came to a close at $2,773 per ounce. In the cryptocurrency market, cryptocurrencies retreated from their Monday highs as bullish investor sentiment surrounding this contentious asset class cooled down after President Trump's inauguration. Crypto investors have hailed Trump's arrival to the White House as a positive moment for the industry. The reason for that being that President Trump has promised to introduce policies supportive of cryptocurrencies, including an accommodative regulatory framework as well as a strategic Bitcoin reserve. According to Coinmetrics, the price of Bitcoin was down from a high of around $109,000 that was hit before Trump was sworn in, before eventually correcting to close the week at around $105,000 per coin. Meanwhile, the broader crypto market, as measured by the CoinDesk 20 index, was flat for the week. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenyan shilling appreciated marginally versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.28 compared to 129.54 that was recorded the previous week. Meanwhile, the sterling pound was priced at 159.44 and the euro was valued at 134.67. And on the regional front, one Kenyan shilling was changing hands for 28.47 Ugandan shillings and 19.40 Tanzanian shillings. And to the Rwandese franc, it was posted at 10.85. The Kenya shilling continues to trade within a very narrow range versus the US dollar. And this price action, where the exchange rate is trading within an extremely narrow range for a prolonged period of time, is both unrealistic and unsustainable. The central bank has previously stated that it does not have a preferred target range for the dollar-shilling exchange rate and only intervenes when there is extreme volatility in the forex market. Based on that premise, the central bank should therefore stay out of the domestic foreign exchange market and let the shilling find its optimum rate through demand and supply. That said, the long-term outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined significantly by a massive $491 million for a grand total of $8.652 billion, which is equivalent to 4.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the interbank market, the liquidity situation in the interbank market was sufficient to meet demand and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this dipped marginally by just 4 basis points to 11.29% compared to 11.33% the previous week. And in terms of volume, the average value that was traded in the interbank market declined to 24.3 billion shillings, down from 34.4 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 21.6 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 23rd of January, and the central bank received bids totaling 32.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance of about 136%, and the results of the auction were as follows. The 91-day rate declined by about 4 basis points to average out at 9.52%, whilst the 182-day rate was flat yet again for the 5th week in a row at 10.02%, and the 364-day rate dipped by just 1 basis point to settle at 11.29%. In the primary bond market, the Central Bank of Kenya, acting in its capacity as fiscal agent for the Republic of Kenya, has published its prospectus for the February monthly bond issue and is looking to raise a total of 70 billion shillings for the stated purpose of funding infrastructure projects as stipulated in the fiscal year 2024-2025. And in this regard, the central bank is inviting bids for the 2 reopened fixed coupon infrastructure bonds, whose terms and conditions are as follows. The first bond, reference number IFB1/2022/14, with 11.8 years left to maturity and a coupon rate at 13.93%. And the second bond is reference number IFB1/2023/17 with 15.1 years left to maturity and a coupon rate at 14.39%. Please note that these bonds are now open for sale until Wednesday, the 12th of February. And for your information, as is the case for infrastructure bonds, please note that the interest earned on these bonds will be tax-free as provided under the Income Tax Act. Please note that these bonds are also amortized, which means that a certain percentage, in this case of 50% of the principal amount, will be redeemed. That means paid back before maturity, and the redemption structure is available in the prospectus. Up next is our topical issue. And this week, we are looking at the Treasury's proposal to strip the central bank of its role in selling Treasury bills and bonds. As part of the reforms that are aimed at reducing the state's borrowing costs, the Treasury has proposed that the Central Bank of Kenya be stripped of its role in selling Treasury bills and bonds on behalf of the government. If the proposed amendments to the law are approved, the Public Debt Management Office, which is a department of the Treasury, will be the one to issue government securities. In its debt management plan for 2025, the Treasury said it was in support of legal amendments to empower the Public Debt Management Office to perform its functions as the principal issuer of government securities. According to the proposal, the main idea is to consolidate the bond auction function under the Public Debt Management Office and to make it the principal agent in the issuance of domestic public debt. The said proposals have set up the Treasury Cabinet Secretary and the Central Bank Governor on a potential collision path. Currently, Treasury bills and bonds are issued by the Central Bank of Kenya, which also acts as the Treasury's fiscal agent. The government has set out a clear ambition of lowering interest rates on government debt securities to below 10% and views the status quo as an obstacle to realizing this goal. Currently, the Auction Management Committee is responsible for determining individual auction results. This committee draws its membership from the Treasury and central bank departments that are responsible for economic research and banking, as well as monetary policy formulation and implementation. This far-reaching policy proposal is intended to shift the country's fiscal and monetary policy to resemble that of the United States. In the United States, government securities are issued by the U.S. Treasury Department, while its central bank, that is the Federal Reserve, restricts itself to monetary policy issues. Despite an earlier presidential directive to maintain interest rates at below 10%, the interest rates on Treasury bills and bonds hit highs of 18.4% and 16.9% respectively in 2024, reflecting a tight financial environment as the central bank raised interest rates with a view to fighting inflation and supporting the depreciating Kenya shilling. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color Podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color Podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve these podcasts, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, you are what you repeatedly do, and therefore excellence ought to be a habit and not an act. Think about it. Thank you, and God bless.